Hey guys, Whitney here. Welcome to the Passive Investing Made Simple boot camp. We do this boot camp every month to help you build your skills in passive investing so you can go into your next deal with confidence, or maybe even your first deal with confidence. Now, these differ a little bit from the master classes. In the master classes, we are kind of staying pretty high level, 30,000 foot view on a topic, really giving you a taste of the various kind of, terms that you should remember and understand. Here, we pull that information into an environment where we can deep dive a little bit deeper into helping you apply these skills and use them to analyze your either goals, your risk, your timeline, or even specifically on how to go into a deal. So today we are going to tackle the due diligence essentials for debt funds. Okay, now I'm going to use our debt fund here at passiveinvesting.com as an example for you. That for those of you who are interested in what our real estate debt fund's all about, great. I'm going to help you kind of pick apart those questions. But for those of you here that are like, man, how do I just take this this particular skill, this set of information, and apply it to other debt funds? You'll be able to do that as well. Now, before we get started here, I want everybody to find their Q&A box. Okay, that is where if you have a question, I don't want you holding on to it. I want you drop it into the Q&A box. So go down at the bottom of your Zoom screen right now, click Q&A, not chat. I won't be looking at the chat box. I'll be looking at the Q&A box. So go to the Q&A box and just drop in there really fast. Tell me where you're joining from. I would love to know. It's always so cool to see all the different time zones that people attend from. So please go ahead and do that right now. Let's see. Yay, somebody's found there. Oh, Dallas, Texas. Yay, I'm a Texan. I don't tell many people. I live in Colorado. So Youngsville, North Carolina, fantastic. Go ahead and, again, drop that in. Every once in a while, we pull somebody from Europe. It's pretty cool that you are taking the time to not only spend it here with me, but also invest in yourself. So for those of you who are just joining, find your Q&A box, drop in where you're joining from. This is an interactive webinar. I want you asking questions. That is the whole point of why we're spending time together. All right. So for those of you who don't know me, my name is Whitney Elkins-Hutten. I am the Director of Investor Education here at passiveinvesting.com. For some people, that is, oh, starting to snow here. Sorry, guys. Connor for Colorado. I'm in Boulder, Colorado right now. Yes, it is gloomy for sure right now. Looking forward to having that precipitation early this year. Okay, back to my story. I started investing in real estate back in 2002. But the whole entire reason why I continue to invest in real estate today, even though that was a complete fluke back in 2002, is because of my crazy crew pictured right here. I have found real estate to be an amazing way to unhook how I create value in the world from the time that I have to spend to do it. Okay, so meaning I'm not trading time for dollars. Okay, how much value I create in the world has no impact on how much time I actually invest to do it. And so to me, that was just really a groundbreaking moment. Even with that first investment back in 2002, I didn't even call it an investment. I was scared out of my mind that I had this property. My relationship had fallen apart. I had all the expenses under my name. The mortgage was under my name. I thought I was going to be sunk. So I rehabbed the property, put it on the market, and sold it. And that's when I went, aha, I made more money in that one transaction than I did in my entire day job that had me traveling, pretty extensively. So from there, I was, then met my husband, who's pictured here. We scaled up, our equity position, doing a lot more live-in flips and house hacks, because that's all I knew. And then it dawned on us one day, hey, why don't we keep some of these flips that we're doing and put people in it as rentals and create streams of cash flow? And then the next question, the next ceiling achievement became, how can we, take even just these rentals were causing us a lot of headache, heartache, and a lot of time involvement, certainly leveraged income, but how can we actually utilize that equity more wisely so we could get our time back. And that's when we stumbled upon the world of passive investing. But you know me, I'm kind of a nut. I'm like, do I run the passive investment or do I invest in somebody else's deal? Well, heck, I can't decide. So let's do both. And that's where it kind of led me down my most recent journey of being able to scale a portfolio of over 6,500 units, residential units in partnership, 2,200 self-storage and 15 express car washes. That's just my personal portfolio. But really the result that's allowed us to have is 100% choice on how we spend our time. I love working. I get to choose how I spend my time, how I engage with people. And this is what I love doing, is teaching people like you how to become more essentially expert passive investors. And, you know, that's really, if you're attending these boot camps, that's what you're here to do, is how do I become an expert passive investor? And of course, we can actually help you do that here at passiveinvesting.com. We have 1.4 billion assets under management and some very strong returns to our limited partner investors. Okay. Now, disclaimer, you know, I have to say, if we get into any conversation, either in the main part of the presentation or in the Q&A afterwards that goes into financial advice, legal advice, tax advice, it's not advice. This is education. You need to take this information back to your team that you build of legal and tax advisors and understand how it applies to you. Okay, I'm going to give you my best educated and experienced guess on how things work, but you need to understand how it applies to you. All right. Now, you're seeing the slide here. It says, what is opportunity cost? You're like, hey, Whitney, I thought I was learning how to underwrite, perform due diligence on debt funds. You are, but we have to start off with opportunity costs, because I feel that there's a real gap here for investors, because a lot of investors, when they transition into the passive investing world, they know stocks, bonds, and mutual funds. There's perceived safety in that compared to investing in, for say, 5 to 7 years in a passive investing equity asset. So we're asking them to go, hey, you know, you have this perceived control, and really it's just liquidity. Okay, you can liquidate your funds, you know, within a day or two. And now let's lock those up into an asset and be partners together 5 to 7 years. Okay. So for some people, it can be like, you know, going on a first date and asking somebody, hey, well, do you want to get married? Okay. There's a gap. There's a hill that we have to overcome here. Now, the reason why I bring up the conversation of opportunity costs is because there is right now in the market, there is a huge transition of wealth happening right now. Okay. So many people are scared. Okay. They're seeing the headlines, they're clicking on the headlines, and they're just like, they're scared, they're running, their flight to safety. But what is happening right now, with inflation being higher, okay, with asset prices starting to stabilize, maybe even come down in some local or regional markets, there's a huge wealth transition happening right now. And I want you to be on the right side of this equation. Okay, so what is this equation? All right, well, let's first define what opportunity cost is. Okay, opportunity cost is what happens if you're in investment A, say like in a money market, have your perceived flight to safety is keeping cash in the bank. Okay, hopefully you don't have it stuffed under your mattress. Hopefully at least now you got it in the bank and you're earning, you know, 3, 4, maybe even 5% in a high yield savings account. Okay, we're recording this in November 2023. If you're listening to this a year from now, I bet you interest rates and bank accounts have completely come down. But you know, you're just like, okay, flight to safety, I got my money in the bank. Okay, but you still aren't probably not on the right side of this opportunity cost equation even then. Okay, so opportunity cost is like where you are today, investment A, okay, maybe the bank, and what you could be getting as a return in another investment if you chose to do that. That delta is your opportunity cost. Let's see what the impact is here. Okay. Okay. So option 1, you could earn 10%, let's say, in option one, investment A. But you got your cash sitting in a vehicle that's only earning you 2%. Okay, that is your option two. That's where your cash is today. So your opportunity cost here is actually 8%. All right. Now, we've got the little picture here. It says opportunity cost is the return on the investment not chosen minus the return on the investment that you're in. Okay. So if you have $100,000 sitting in the bank and your opportunity cost is 8%, you're losing, your opportunity cost is $8,000. Right. Okay. But that most people stop there. They're like, oh, $8,000. I'm okay with that, a little bit of erosion to keep my money safe in the bank. Okay. Here's where you need to be on the right side of this equation. Okay. It's not the $8,000. Okay. It's the $8,000 compounded out at 10% over, let's say you lost $8,000 year one, but that $8,000 is $8,000 you never could have earned and you never could compound it. So now over the next 29 years, you actually lost $126,000. Now, what happens if you continue to make the same mistake year over year over year? Okay, this just compounds even further. Okay, that's why I'm saying there is a massive wealth transfer happening right now. Okay, it's people that understand not just like, hey, put your money in any investment, but how do I underwrite an investment to safeguard my capital and be on the right side of this opportunity cost equation. Okay, those are the people that are going to sail through inflation, recessions, with a smile on their face, and they're going to build generational wealth. All right. All right. Now I just have to bring that up because let's start kind of using this opportunity cost and what it is in today's market. Now I put this grid together back in April. Okay, we see our cash, erosion or inflation at 4.98% here. I just checked it right now before I got on today's webinar. At the end of September, we're like at 3.6. Last year, we're up over 8%. But I just left this here because this was all nice and pretty, not too far out. So if you're sitting in the bank and you're losing, say, even like 3 or 4% on your money, okay, all right, you have to be invested at least in the money market to be breaking even right now. Okay. But let's just say that you're just sitting in all cash in a checking account. All right. You compare to other assets, this is what your actual loss is, right? Your opportunity cost. All right. So today we're going to be talking about this space around secured notes. All right. So right now, if you're not in a secured note, you're potentially losing 10.98% not being in a secured note, right? Let's say you actually are at net zero and you have your cash sitting in a money market account earning 4.5%. You're still losing 6%. You still have like a 6 or 7% opportunity cost, right? Gold, we're about net zero, right? Cryptocurrency has rebounded a little bit back. So these numbers aren't exactly fair to cryptocurrency, but that's hugely volatile. Paper assets like the stock market, we're still down, actually probably down a little bit more than it is today. So these numbers are actually more advantageous than they really are. So you can see here, opportunity cost is a huge thing that we need to consider in our portfolio. And that's why I wanted you to help you understand how to underwrite secured notes, right? Because note investing is kind of that bridge for some people between moving from stocks, bonds, and mutual funds. And they're not quite ready to go into equity assets. Either, they just can't wrap their head around them, or that's just not a risk they're wanting to take. Okay, so they do nothing. This is the cost of doing nothing. All right, I'm going to get off my soapbox there. Okay, hopefully that was a useful illustration of why that this is a super important topic to kind of wrap your head around. That even in today's environment, if you are nervous about going into an equity asset for whatever reason, that you should consider adding a debt secured note debt profile to your portfolio, right? In order to be on that right side of this wealth transfer equation that's happening. Notes are a debt instrument. That question came in. So yes, you are correct. Okay, it is not. Sometimes they come with profit sharing, but we're not going to complicate that, right now. We're just looking at just the debt instrument. So essentially, you're being the bank. You're lending the money to somebody, all right? But how do we make sure, again, rule number one of investing, don't lose money. Rule number two, see rule number one. So that's what we're going to learn how to do today. All right. So now that we've kind of gotten my soapbox out of the way with the opportunity cost, let's get down to brass tacks. What is a debt fund? Okay, how can this be a good instrument to add to our portfolio? Okay, to continue to grow our wealth when we're not quite sure what's happening, or we need to be, that's not the favorite space of investing in, or we just need to be liquid. All right. So a real estate debt fund is a type of investment that specializes in providing debt financing, okay, for real estate projects and investments. Okay, these funds actually, what we do, what people who have debt funds, they raise capital from investors, and then they put it into an instrument that they can then go make loans or invest in other debt instruments that are backed by real estate. Okay, debt funds are typically managed by professional investment teams, which is, yay, a bonus for anybody who was on my webinar yesterday. We talked about the legal advantages of being in a passive investment. That is something that we want to take advantage of. And you want to make sure that, these people, the professional managers, actually have expertise, not only in real estate, but in lending. That is super important, okay? I've seen operators open up a debt fund, and they have good knowledge of real estate. They have knowledge and expertise. They know the markets, but are they good lenders? I don't know. Let's get down to the questions that will help us suss that out, okay? Now, there's all different types of debt funds out there, okay? So I'm sorry, guys, I'm in a group, an investment group where there are some really savvy investors that are in some very risky debt positions, okay? I call them momentum investments. They're able to do that, okay? They're able to take on that risk. But I just want you to know there's a whole sliding scale of even risk in the debt market, okay? We've got primary mortgages, commercial real estate debt, residential debt, distressed debt, okay? You get it, high risk, high reward, go into distressed debt. You can lend debt privately. You can do it through a crowdfunding tool. You can be in the senior position, get the first loan, or you can be in a mezzanine position, in the second or third position, lending position. There's all different kind of flavors of this. So you really have a choice. For me, I look for first position lien, senior debt, because that is the safest position to take right now on real estate. Okay. If safety is a question that you need to have, if that's something that you need in your portfolio, fantastic. If you're okay taking higher risk, different risk positions, a lot of the things here still apply to you for due diligence. Just know that you're going to be assessing out that additional risk profile. But when we're talking about positions that take on the senior debt, that first position lien, meaning if the borrower had to hand the property back or sell it, you get paid off first before anybody else. There's some key characteristics that we want to make sure that we're looking for. We want to look for that priority in bankruptcy. Okay, are we in that first position? Are we going to get our money back first before anybody else? If we're in that priority position, we're going to be at a lower risk because we are first. Okay, debt. Key characteristics of debt funds, they generally provide fixed income associated with them. Okay, not to be confused with the preferred equity fund. A lot of people go into preferred equity fund thinking that it's debt. Okay, you're not on the lending side of things. Okay, you're on the do we make money when we make money together and lose money together side of things. Okay. So debt, we're on the lending side, generally fixed income, generally very stable income. And one key characteristic when you go into a fund there is a compilation of loans that are being, that are in that fund that are diversifying your investment. Okay. It's not like you just writing a private note to a borrower where, you could do $100,000 note to an individual borrower, or you could do $100,000 investment into a debt fund and be diversified, say over 1,100 or 1,200 borrowers and deals, I should say, and the various borrowers and markets that make up that profile. All right. So hopefully that what it is, why it's important for us to kind of wrap our heads around, what kind of debt instrument we want to use is we've answered those questions. Now let's get into brass tacks. How do we perform the actual due diligence? And this is where I really encourage people, as always, take pictures of the slides, okay? Build out your own spreadsheet of questions, add in other questions. So for me, when I'm starting off doing due diligence on a debt fund, I'm doing the due diligence. We always talk about this when we talk about equity. It's not the horse, it's the jockey riding the horse, okay? It's not the deal, it's the operator running the deal. But in the case of a debt fund, you probably are going to have two operators, okay? One's going to be the operator of the fund. The other one's going to be the lender lending the money, okay? So we got two people to underwrite here, right? Or two groups to underwrite here. And I just put a little quick picture here to help on how our debt fund structure, so you understand the relationship. So for, if you're in our PIC debt fund 1, okay, that's the aggregation of investor capital. Okay, Rehab Wallet is the lending arm that actually writes the notes. Okay, and that's going to be really important here in a minute as we move through our due diligence questions. Okay, so overarching, we want to understand what the fund strategy is. Okay, this is going to be a conversation with the operator. Okay, with the lender and the operator, like who is lending the money? Okay, what is it being lent for? Okay, is it being lent for single family or multifamily? Is it stabilized single family or is it fix and flip multifamily? You're going to want to understand what the overarching strategy is. Is that company vertically integrated? Okay, or is that relationship between the operator aggregating the funds and the lender lending out the funds, are they vertically integrated or are they two separate entities? Okay, I've seen some debt deals where you invest in the debt fund and then the operator has carte blanche control on who they lend to. Okay, and if one lender goes down, they can switch lenders on you, okay, which changes the whole risk profile of the fund. All right, so you want to understand what's happening there, what that relationship is. What is the lien position? When a note gets written, are you in first position, second position, third position? Okay, what asset class, single family, multifamily, business, who knows? Where are the loans being originated? Okay, what states are the these loans being written in? The laws around origination in say like the southeast part of the United States are going to be different than they are out west or in the northeast. Okay, how do those states favor businesses? We want to understand that. What is the lender's experience with not only lending, but lending on that particular asset class and in that market? Okay. Okay. Do they understand the market? Do they understand how multifamily or single family operates in that market? Right. We want to know the answers to that question. Okay. And then when we talk about the fund operator, the people that are aggregating the money, and this can go for both like the lender as well as the fund manager. What is their background, track record, and expertise in raising funds and then deploying the capital? Okay, do they understand how that relationship works and that delicate balance between money going out, coming back in? And if there's a liquidity feature, do they have the business practices in place to make that liquidity option very smooth for you as an investor? Okay, so start there, and really make sure that you understand that overarching strategy. Like for us, on our debt fund, we do single family fix and flip investments in the Carolinas, southeast part of the United States, primarily the Carolinas. You know, our operator, our lender has been in, we have over 40 years experience between our, you know, lending team as well as on our real estate team. Tons of background and experience there. I'll show you there at the end, but those are the type of questions you're trying to suss out. Okay, next phase. Once the operator and lender check out, now let's get down to the borrower. Okay, this is kind of like getting down into, all right, what does the deal actually look like if you were underwriting a multifamily deal or a self-storage deal? We're starting to kind of get down in the brass tacks here. Okay, I first want to understand the risk mitigation plan. How are they underwriting the borrower and the asset? Okay, because, you know, we want to make sure that that borrower can pay the interest on these loans. Okay, and that they're actually going to be able to dispose of the asset and exit the loan when they need to. Okay, how are the borrowers underwritten? All right, how stringently? Is the borrower putting up a guarantee on the loan? Are they pledging their own personal assets? Or is it just, you know, the actual asset that's guaranteeing the loan? Okay, we want to know that. Okay, personal guarantees aren't necessarily better. Sometimes it's actually better to have like a non-recourse loan with what we call a bad boy carve out, meaning that the asset gets pledged. If the borrower can't pay the bills, the lender gets to take the asset back. And if there's a deficiency, then, or any sort of fraud, they can go against the borrower. Okay, sometimes that's a better arrangement. Okay, puts the lender in more control. Is there a third-party valuation of the asset that's being performed? Okay, I've seen lending programs where they just kind of like, it's a doc program, like they just, you know, do everything by tabletop and they're, you know, just taking kind of the borrower's word for it. You know, I like debt funds where they're actually hiring a third-party appraiser to go out and determine the value of the property as it is today. And if it's a rehab, what is it going to be after the business plan has been executed? What is the typical loan to value that's being deployed? Okay, is the lender doing loan to value of 80%, which is pretty high in today's market, or are they closer down to 60, 65%? Okay, and that's kind of where we're lending at in today's market. How long is the loan for? Okay, now, you know, if you are kind of in your retirement age, maybe you're okay with longer loan extensions. If you're in your accumulation phase, you probably are going to want to see loans cycle out faster so you have better velocity of your money, and also, you know, a little bit more wiggle room if you want to have like liquidity. Okay, so you know, sometimes, you know, having your funds locked up longer is not better for you from a financial standpoint. Okay, for us, our typical loan is 6 to 9 months. How do loans exit? How often? Right? What is the borrower default rate? Okay. You know, I like looking for lenders that actually have an experience, you know, before the Great Recession. Okay. They've been through some really deep, tragic times in 2008, 9, 10, and 11, you know, dealing with taking properties back. Okay. And just because you have to take a property back, just because a borrower defaults, you know, if the valuation of the property is, you know, if you're underwriting high quality property at a low loan to value, okay, not that you want to take the property back, that's not the point, but if you did, it actually might make you more money. Okay, so we want to limit defaults as much as we possibly can, but if there is a default, that's not always the worst case scenario. Okay, the worst thing in the world for the fund. But look for low default rates. Okay. Now we've gotten through the operator. You're looking at the fund operator, looking at the lender. We now looked at the biggest risk in the fund, which is going to be the borrower and the asset. Now it's time for us to look at the overarching offering. Okay, how's the offering being structured? If we like the lender, we like the operator, we're like, okay, they've got a good risk mitigation plan with how they're underwriting the borrower, how they're underwriting the asset. What does the deal actually look like to me? All right. Well, I want to make sure that there's a preferred return. Okay. For me, I want If the fund's lending money, it's doing well, I want to make sure that I'm getting the first cream of the crop of, a return off the top. Okay. Are investors diversified across the entire pool of loans, or only, when they enter and any loans written going forward? I want to be diversified across the whole pool of loans, right? That lowers my risk as an investor. Another question, how many loans have to perform in order for the investor to get the preferred return? That's kind of like assessing the break-even occupancy on a multifamily deal or a self-storage deal. I like looking for debt fund profiles where, only say 55% of the loans, maybe even 60% of the loans have to perform or for the pref to get paid, right? Are your funds securitized by the hard assets that are held in the fund, or are they securitized by the business? Okay, you want to make sure that your funds are securitized by the assets that are held in the fund, okay, not the lending business that's running the fund. Okay, very important difference there. How are distributions paid? Okay, are they paid monthly? Are they paid quarterly? Are they stable, fixed, stable payouts? Or is there some other type of payment structure there? Okay, how quickly are your funds invested? All right. Sometimes you could, invest into a deal, all right, and then your funds aren't deployed. Maybe the operator has 4 to 6 months to deploy your capital. In debt funds, we want to see that deployment down to like 6 weeks or less. Our average deployment timeline is right around 2.5 weeks right now. Okay, we want to see quick deployment so you can start earning that preferred return pretty quickly. Okay, is there liquidity? Okay, this is kind of like a bonus. Are there liquidity features? Are there redemption terms? Okay, are your funds locked up for a period of time? I like looking for funds where there's no lockup feature, meaning once I'm invested, once my funds are deployed, I literally, technically the next day could request my capital and get it back within 90 days. So, we understand what those liquidity and redemption terms are. Is there monthly compounding? Okay, right? Like, so just because, if we ask about liquidity and redemption features, that could be good from a short-term strategy standpoint, maybe keeping funds invested while you're continuing to earn returns or looking for other places to deploy capital. However, maybe you're looking at this as more of a long-term investment strategy, say like in a self-directed IRA or something like that. Is there monthly compounding? Could you continue to earn a return, if you kept your funds invested? But above all else, okay, ask these questions of the team, look at the offering memorandum, check these boxes, but make sure that all your research is completely verified in the PPM. Okay, so again, the PPM is the legal document you sign. It's the end all be all, document for the deal and offering. So make sure it's listed in there. Now, I already kind of alluded to this. Not all debt funds have liquidity features or compounding features. So those are things that could be additional perks. But the biggest perk about going into a debt fund as opposed to originating your own notes directly is you get enhanced diversification, meaning you can go into markets, asset classes, spread your risk out over borrowers just with one capital placement, right? This can save you a lot of headache and heartache, and quite frankly, just time of trying to source all these individual notes yourself. All right. Now, I wanted to kind of clue you in on the compounding feature. I'm going to show you what our compounding feature looks like, but this is something like you want to ask this question. For those of you that might be using debt funds as a longer term investment strategy, pairs extremely well with self-directed IRAs, retirement accounts. Look for a compounding feature. And this is just, for us, this is based on a $100,000 investment. Okay, so there's some assumptions here. For us, that our $100,000 placement into the preferred, our debt fund earns an 8% preferred return. Okay, so if you allowed your distributions to stay in the fund and continue to compound, by the end of year one, it's actually an 8.3% return instead of 8% preferred return. By the end of year five, sorry guys, I can count here, it's 11.4. Okay, right? For people that have a longer timeline horizon, this can be very cool. By the end of year 10, it's over 17% return. Okay. And here are just kind of like what your capital of balance could look like. So essentially in 10 years, if you just kind of let it continue to compound, you've got a pretty hefty capital balance built up here within a debt fund that has a compounding feature. All right. But again, guys, above all else, look for operators that have the expertise and the knowledge to run this type of investment. They got the knowledge of the strategy. Like we've, deployed over $223 million in loans, over 1,150 loans. We have our systems and our team built out. We've have a track record and history of taking deals for full cycle with a track record of performance. We had the ability to pool capital, very readily. And we have over 40 years combined of lending and real estate management experience, including our full-time team, ready to assist our investors. Now, guys, I know we're kind of going to the Q&A portion of our boot camp. I want to open that floor up to any questions. No questions have come up during the actual course of conversation today. So now is the time to go over to your Q&A box, dump in your questions. I'll stay on the line here and help you answer them. But for those of you who are joining us via YouTube or your favorite podcast player of choice, if you want to learn more about what we do here at passiveinvesting.com, but certainly about this debt fund, you can reach me at passiveinvestingwithwhitney.com. Got some free goodies there for you. But most importantly, if you're interested in learning more, jump on my calendar and get a free one-on-one call to discuss your goals. You'll also end up on our list and get free access to our various educational opportunities, our masterclass and our boot camps, and of course, see our priority access to our deals.